Hi everyone. After a while, we have decided to continue our uh, videos for the betterment of the professionals, especially accountants. Today, the topic is basically an interesting subject for those who are living in Dubai, UAE, because it's relating to properties, property managers. So, since we have many, experiences with regard to the taxation, this video probably will be, of many importance to those who are living in Dubai, as the taxation is quite new subject for Dubai. So let me briefly, explain the areas that you can focus, especially with regard to taxation of homeowners association. So let me share the presentation. Right. Rethink taxation of homeowners associations. So I'm trying to give some precedents from Sri Lanka to Dubai. As I said, it's comparatively a new subject to Dubai. So that let's try to grab something out of this and try to, rethink. That is why I have mentioned rethink about taxation, because many of my friends living in Dubai, they have this question whether the surplus of homeowners associations are taxable, whether that is taxable or not for income tax, because Dubai, you have now 9% corporate tax. Um, is it really taxable? So I'm not going to tell you exactly whether it is taxable or not, but I am, offering certain areas that you can, revisit and rethink about the taxation of homeowners associations. Right. So let's look at the condominium property in Sri Lanka, right? So, so when you have a condominium property in Sri Lanka, there is a separate association or body corporate, we call it, by the operation of the apartment ownership law, right? Which is formed for the sole and exclusive purpose of maintaining the common area of the property. So that is sort of a association where the with the I mean where the members are the owners of the condominium parcels. So I think it's more or less the same sort of structure is there in Dubai. So even the structure wise, even if it is different, that's all right. But there are certain important areas that you have to focus here. Firstly, is the association a taxable person? That basically depends on your legislation. But in Sri Lanka, if you look at the Inland Revenue Act, Sri Lankan Inland Revenue Act, that is number 24 of 2017, clearly these sort of associations or body corporates do fall under a taxable person, under the definition of a person. So I'm going to explain in detail, but it is a person for tax purpose, probably in other countries as well. So the second question I have is, what is to be taxed here? What are you going to tax? So to tax, what do you have in your hands? Basically, you need to have income or profits, basically the profits. So, so profit arise from what? Is basically from income, right? So what are the sources of income you have? Being an association of members, basically membership income and other income, right? So here, I'm not going to focus on the other income, because that's you have to give the normal treatment for other sources of income. But the key question here, does the receipts from members fall within the meaning of a source, that is a taxable source? And simply, the income, contribution, subscription, or whatever you call it, are they really liable for income tax in whatever the jurisdiction you are in? So let's look at. should we really consider them as income? Here are a few, ideas that you can further develop. The purpose of this association. It is basically formed with the sole and exclusive non-commercial purpose of maintaining the common area of the condominium property. Right? So why I'm focusing on the common area, because if you serve particular person's residence, the condominium parcel, the rooms or whatever the properties, that's a separate service. But here the key focus is on the common service element, right? So basically it is for non-for-profit, basically not for profit, and there is no commercial purpose, but because they need to maintain the properties, commercial, the common areas, so that they have jointly formed an association, body corporate, we call it here in Sri Lanka. Right. That's all right. Purpose itself, by looking at the purpose alone, you can't say whether it is taxable or not. Let's look at the other areas as well. Now, what in your P&L, what do you have? You have amounts collected from the members for what? That is basically to repair, to maintain, your property, the common area. So end of the day, end of the year, you will have a surplus or a deficit. The surplus you have, is it really a profit? Not really. It is not so, because say you have collected X amount, whatever, say for an example, 10 million rupees, and you have spent 9 million rupees. So there is balance 1 million, which is a surplus, and you're going to spend it in the next year, right? And it is the general understanding, these profits you can't distribute generally. So it is kept for, future renovations, maintenance, etc. So by looking at the very nature of it, it is not a profit. It is a surplus that is kept for future, renovations and other activities. So very clearly, it is not a profit motive organization. And secondly, it is not a profit at all. It is a surplus that is kept for future, repair, renovations, or whatever activities. Clear? The third point I want to emphasize is whether it is an income or a capital receipt. The contributions by the members represents fund held by the trust, in the trust by the association, to defray for the cost of maintenance and preservation and etc. So the amount collected from the members cannot be considered as income, but rather they are collection of, basically the capital receipts. So that you can put them under any other sources that are taxable. So that is another thing. Now, 3 points. One is it is not for profit, basically. There is no profit motive here. And secondly, it is not a profit at all that you report, that is a surplus. Thirdly, the receipts from the members represents capital receipts, right? So these are some ideas for you to think, rethink, and align with your legal provisions, align with your business structures, align with your, structures and the way you treat them, way you, work, and you have to come up with your own this thing. So next, there is a very, important principle, the principle of mutuality, meaning that one cannot trade with himself. The association in general is not considered as a separate person, but rather it is considered as part of yourself. Say for an example, say a general simple example, there is only one, property owner in the apartment, right? Just for you to explain one point. So then it is you contribute to the association for the betterment of yourself. So you are transferring funds from the left hand to right hand. So that's not an income. So this is a well-established principle where you don't need to consider them as an income, because even under the previous Inland Revenue Act, 2006 Inland Revenue Act in Sri Lanka, this was admitted. And so therefore there were different, deeming provisions to capture these sort of associations. But now under the new Inland Revenue Act, 2017 Act, we don't have any specific provision. So that it is clear, in my opinion, these are not profits, so that it is not captured within the chargeability. And especially with this strong principle, the principle of mutuality, you don't need to consider, because you can study the principle of mutuality. The members and the associations are not considered as two different persons. So that it is not an income earned by another person. The fourth point. Next, now I said there is no any specific provisions in the Inland Revenue Act. So when there is no specific provision, so you cannot impose taxes. That is well settled. I have given some precedent cases, and you can refer like legal literature like Maxwell on the interpretation and etc. So where you will find this principle where tax cannot be imposed without express provisions. So that if you better look at your legal provisions in your destination, in your country, and see whether there are any specific provisions. If there is nothing, so just go to the fundamentals, whether this is a profit, whether this is formed for the purpose of generating profit. Are we engaged in a business or an investment activity, basically a business activity? Not really. And is it really a profit? Not at all, for me at least. So because why I said so, because the Inland Revenue in Sri Lanka, they have a control review with regard to this, so that you better discuss with your revenue officials and take your decisions. And these few points will give you some understanding about the taxation of the homeowners association, because again, why we video basically to give some understanding of, to the accountants, those who are working in Dubai, and so that you can further study this point, because you have a lot of materials on these subjects, and read and understand, and then you can liaise with your revenue authorities to come up with a better solution. But finally, taxing the surplus is totally an absurd, because let's say you have two associations. One association might spend the entire thing, where you have zero surplus, and the next association, they might not be able to spend everything. So profit, the surplus is within your control, because that depends on how much you spend. Profit is not that. Profit is the remainder of all your hard work. But here it is not the case. But in this process, there can be different persons who are gaining, who charges from the association, who charges from the property, etc. Those are taxable, obviously. But I am emphasizing here the taxation of the association. So principally, in conclusion, it is not a profit, but it is important to look at the structure, the model, and the legal provisions in your country, and then take a call. Right. I hope you gain some understanding from this. Thank you.